So already we've seen the Japanese government intervene in the currency markets. They haven't done so in a while, and it's very rare that we see policymakers intervene by buying yen. And I think that this certainly signals that policymakers have little tolerance for further depreciation of the yen. That certainly brings to mind if the yen depreciates further, they would be importing inflation through purchases of imports. Now, what I would say is that the big component here is the strength of the US dollar, which is really impacting the depreciation of the yen. And I think that already we've already heard from the FOMC, from Jay Powell, that we aren't going to get further rate increases, and instead that the next move, I think, will be a rate cut, perhaps later on in this year.
Okay, so looking out for more Fed speak for clues on exactly what the Fed's going to do next. And you are right, it's probably that long-term policy divergence that has created the moves that we've seen in the yen and, of course, the strength in the USD. So let's unpack your strategy moving forward as well. You say equity performance could diverge further by region, driven by domestic fundamentals and valuation starting points. You favor Europe and EM over everywhere else. Why?
That's right. I like Europe because I think valuations are quite compelling when compared to other developed markets. We're starting to see a very dovish talk from the ECB, and it's very possible that we could be seeing a rate cut very shortly. This would be positive for risk assets. And also, the economies of France and Germany are starting to improve. And I think that certainly is reflective of the global macro backdrop that is decelerating a bit. Now, when it comes to EM, I think previously there's been kind of this sell in May, go away. I don't think that's going to happen this time around, given the positive sentiment that we're seeing in Chinese markets. I think that will just likely to continue.